Thank you. Hello and good evening. A very warm welcome to all our listeners today. Thank you so much for taking out time and joining us. I promise you this session is going to be useful, and I'm sure you're going to learn a thing or two. All right, so I'm going to begin on the note just to give you a heads up. Uh, Clear tax, which is now clear. We are on a simple mission, like a very simple goal, which is to simplify the financial lives of Indians. And we've come up with various products. We have exciting things lined up for you. But before I begin talking about our product, I think it is a very good time to talk about tax saving. I think any day is actually a good day to talk about tax saving. More so now that I'm sure many of you are busy putting together tax saving proofs to submit to your employer. You may be worried about how much taxes you're going to be able to save in the financial year, which is now going to finish, which is financial year 2022. It's going to end on the 31st March of 2022. So you still have a few months to do your tax saving, to understand about taxes. And like I said, any day is a good day to learn about taxes. So let's get started. Here's a quick look at what we are going to learn about today. There's been a lot of talk around, the new tax regime, the old tax regime, and I'm sure you've all filed your tax returns for financial year 2021. The last date or the due date for those tax returns was 31st December 2021. It just went by. And if you haven't yet filed, please make sure you file your tax return for the last year as soon as you can, because you already will have to pay a penalty for delayed filing. But if you file now, at least you will be able to save some interest if you have any taxes due. So that's about your tax filing. But here's a quick look at what we are going to learn today. We'll understand a bit about the new and the old tax regime, and I'm sure all of you have already filed your tax returns, so you'll understand it even better. We'll talk about how you can reduce your tax outgo, and that's a fancy number, 46,800 rupees under Section 80C. We'll try and understand what this magic section can do for you. Then we'll come to the best tax saving instrument, which is ELSS, without doubt, and we'll talk about it in more detail to help you understand what exactly ELSS is. Then we'll talk about saving taxes beyond ATC, because we always talk about ATC and people keep asking, okay, tell me some newer ways, tell me some different ways other than ATC. So I'm going to touch upon that. Then we are going to show you how our app, which is called Black, and if you've not yet downloaded it, please go ahead and do so. Black is an app by Clear, and we help you save taxes. You can invest. You can buy mutual funds. You can file your tax returns. It's a complete finance friend for you. So I'm sure there's value in downloading this too. So please go ahead and download it if you haven't yet already. And then we're going to just give you a few smart hacks that you can use to increase your take-home salary. Of course, as salaried individuals, we may not have many sources of income, and salary is our major source. And therefore, we are pretty focused on, how we can increase our take-home, how we can reduce our taxes. And today's session is all about that. So let's dive right in. All right, now let's try and understand if the new tax regime can do us any good. Now, before I start talking about it, let me just tell you that less than 10% of people who filed their tax returns on Clear Tax did not opt for or less than 10% people opted for the new tax regime. So an overwhelming majority, 90% people filed their tax return via the old regime. Now, what exactly is the old regime? Because I'm guessing there may be a few people in the audience who may be filing for the first time, or who have filed their tax return and who are still unsure what this old and new regime is all about. So I'm going to take a moment to talk about these two regimes. Now, the old regime is where you are allowed to claim certain deductions and exemptions, and these are usually, working around your salary, allowing you reimbursements, allowing you exemptions. For example, you may have heard of house rent allowance. Now, most of the salaried people get HRA from their employer. If you're living on rent, then you're allowed to claim a certain deduction from HRA. Similarly, you have reimbursements. So your employer may have structured your salary in a fashion that you're allowed to claim certain reimbursements. And then, of course, there are deductions such as Section 80C, and I'm going to talk at length about 80C. So the old regime allows all of these benefits. The old regime allows you to claim certain expenses, to claim certain deductions, which reduce your taxable income, right? And the new regime says that we will offer you lower tax rates. There are tax rates are definitely lower, but you have to forego all the exemptions and deductions that are available in the old regime. For example, in the new regime, you don't have any of the HRA, LTA, Section 80C, whatever you may have heard of, except a few, and the notable amongst them is NPS, which is the National Pension System. That's the only deduction which is available under the new tax regime. And there are just maybe a couple of others, but I think in the larger scheme of things, those are pretty irrelevant. None of us are going to be able to claim it. So largely speaking, under the new regime, you have lower tax rates, and under the old regime, you have higher tax rates, slightly higher tax rates, but a wider opportunity to save taxes. Now, with very little effort, you are able to save 46,800 rupees, and I'm going to come to that in a while. But let me just, give you a perspective that a large number of people have not opted for the new tax regime, and I'm pretty sure budget is around the corner, and soon government will release statistics where they'll their own filing details, where I'm sure they're going to spell out that not many people have chosen the new tax regime. Now, the new tax regime is mostly for those who are looking for a higher cash flow on a month on month basis. So because these have lower tax rates, you may have slightly higher, better cash flow, which means you may have more cash in hand. But the beauty of this regime is that you might be paying higher taxes. So it's only for a very few people, and I'm not going to throw any numbers at you, but let me just help you understand that for most people, if they make little bit effort, if they try to maximize ATC, if they work around their salary in such a way that their employer is able to offer deductions and exemptions, then they are going to benefit from being in the old regime. They'll save taxes, they'll invest their money. They may have slightly lower cash flow, which means they have a slightly lower take home salary, but overall speaking, they pay lower taxes. And yes, if you're a taxpayer, you know how much it pinches to pay your taxes. So I'm sure, when we start paying taxes, we're always looking at way to minimize our tax liability. So in that sense, I would say don't, scratch your head around this issue. Just understand that for most of us, the old regime is beneficial, provided you meet two conditions. The first one, that you maximize Section 80C, and I'm going to come to that. And the second one, that your salary is structured in such a fashion that you're able to claim exemptions on various allowances. You structured it in a way that you have reimbursements, and there are ways for you to minimize your taxable income, your taxable salary income. Then trust me, you're going to benefit from being in the old regime. Now, the only flexibility I think that the new regime offers is that it doesn't tie you down to traditional products. So ATC, typically, you're required to invest in PPF, which is a public provident fund account. I'm sure you've heard of PPF from your parents, from your family, or maybe your friends. It's a traditional way of investing where you deposit money in a PPF account, which works pretty much like a bank account, and you're not allowed to withdraw for a very long period of time, a minimum of 15 years, even though you can withdraw for emergencies after 5 years. But mostly, it's a kind of a type of an old product. There is a fixed rate of return, which usually ranges between 7 to 8%. And it's tax free. Definitely, there's no tax on the interest income. There's no tax at the time of withdrawal. and it's historically been a much loved product. But the only downside is that you can't deposit more than 1.5 lakhs in one financial year. So what the new regime does is that it does not tie you down to these traditional products, because you don't claim ATC, you don't do the usual EPF and PPF, and all the usual stuff that most taxpayers end up doing. But let's try and understand, let's dig a little more deep into how you can truly benefit by saving taxes and by investing in some of the products which are eligible under section ATC. Right. So, I've done here a quick display of how you can save taxes with ATC. Now, I'm just going to go to the basics. So, if you are someone who's never understood what ATC is, it's not anything fancy. It's not anything complicated. I'm going to try and demystify it for you. So, when you're doing your tax calculations, you have to aggregate your income from all sources. So, you need to pick up your salary income, if you have any rental income, if you have any interest income. Those are the incomes that you need to include. Now, most of us, who are salaried, we'll usually have, of course, salary income, and then we may have interest income from a bank or from a fixed deposit. Now, roughly, you just total up this income and see what the number is like. Now, what section ATC does is that allows you to remove 1.5 lakhs from your total taxable income before you apply tax rates, right? So let's just understand it again. Aggregate your total income, and under section ATC, if you've met the conditions, you have a maximum limit of 1.5 lakhs, and you can reduce that 1.5 lakhs from your total taxable income, and on the remaining income, the tax slabs or the tax rates will be applied. Now, I'm going to take a quick example. Say, for example, your annual income, including salary, including interest, all of this is rupees 10 lakhs. Now, from rupees 10 lakhs, you will be allowed a deduction of 1.5 lakhs under ATC, and we'll come to how you can claim that deduction. But if you exhaust that 1.5 lakhs under ATC, then 10 lakhs minus 1.5 lakhs leaves you with 8.5 lakhs, and your tax will be calculated on 8.5 lakhs. I hope that makes it very clear as to what section ATC is capable of doing. It reduces your total taxable income. It reduces the income on which tax rates are applied. Now, how do you get to that magic number of 1.5 lakhs? Now, there are several instruments which are eligible under ATC, and it's a big basket of various investments, various expenses that you can claim under ATC. And we spoke about PPF. Then whatever you contribute towards your EPF, towards your employee provident fund, also forms part of ATC. Remember, this is the contribution that you make. Your employer also contributes, but it's only your contribution that is eligible under section ATC. So your contribution to EPF, then there is PPF, which is Public Provident Fund. Then you have a 5-year fixed deposit, which is eligible. So if you go to a bank and you do a fixed deposit for 5 years, even that is eligible under ATC. Then you have life insurance premiums. Then there are certain expenses which are eligible. If you have children and you pay their school tuition fees, then even that is eligible. You can claim school fees under section ATC. If you have a house which you have taken for which you have taken a loan, and you are making repayments of the principal amount of the loan, then that principal repayment is also eligible under ATC. And there are a couple of other things, and we can explore at length at some time later. But here's a look at how this really works. So say if you have a basic salary of rupees 20,000 per month, it could be anything for you. But assuming you have 20,000, then 12% of that amount is your contribution every month. So your monthly basic is 20,000. Now 12% of that is contributed by you to your EPF account, and you can just check that balance from your monthly pay slip. You'll see a deduction towards EPF. This is that. Now, what I've done is I've just multiplied, I've just calculated 12% of 20,000 and multiplied it by 12 months to get an annual contribution number to your EPF account. This is the number which is eligible under ATC. Now, if you do an ELSS of say 96,000 rupees, which is a SIP of rupees 8,000 per month, I'm sure in these times, if you're salaried, it may be possible for you to afford that kind of a SIP. Saving money is difficult, but if you're diligent about it, I'm sure if you're like able to take out 8,000 rupees a month from your salary and do a SIP to ELSS, then that SIP is eligible as a deduction under ATC. I have assumed that you're paying some life insurance premium, so that annual premium payment is also eligible under ATC. And then you've actually crossed the threshold. So somebody with a basic of 20,000 a month will be making a contribution to their EPF of 28,800. If that person attempts to do an 8,000 worth of SIP every month towards an ELSS mutual fund, and let's say they are paying a life insurance premium, then they've already hit that golden number of 1.5 lakhs. And you're eligible to claim this deduction under ATC. You're eligible to reduce 1.5 lakhs from your total taxable income. Now, assume you are in the 30% tax bracket. It may be lower for others, but if you are in the 30% tax bracket, and remember, in both the regimes, whether you are in the old regime or in the new regime, income beyond rupees 15 lakhs is taxed at 30%. So our taxation is actually done on the basis of slabs. And when your income, whatever portion of your income falls above and beyond 15 lakhs, is taxed at 30% under both the regimes. So whether you opt for the new or the old regime, that is the tax rate that applies to you. And on the total tax calculated, say for example, your tax calculated is rupees 40,000, then 4% of that 40,000 is the cess you pay. So when we do this kind of calculation, we realize that if you are able to fully exhaust 1.5 lakhs worth of ATC, you will save rupees 46,800 and as taxes. So that's tax saved is money earned, and that's how you can make use of Section ATC. Now, I just want to highlight to all of you that it's actually fairly simple to track this number. So, if you go to, if whatever mechanism your employer is using to offer you pay slips, just go and ask for a tax computation and you will be able to see how much of ATC you've exhausted, whether you've completed that 1.5 lakhs or not. And if you haven't, you still have that time period available with you. You can make an investment into ELSS or you can get into one of the products eligible under ATC. And if you do that before the 31st of March 2022, then you will be able to save taxes. You will be able to claim ATC within this financial year. So it's a golden opportunity, and I really recommend that you don't miss it. Now, let me give you some statistic that we did an analysis of how many people actually exhausted Section ATC in their tax returns, which they filed on Clear Tax, and we realized just 5% of taxpayers have exhausted their Section ATC. And, it's simply like you're leaving money on the table. So try and make that attempt. And, one of the easy ways is to do ELSS. And I'm going to come to that. And I'm going to explain why ELSS is the most sought after and probably the best investment that you can do right now. And don't worry about, submitting tax proofs to your employer, because so long as you do ATC, you can even claim it when you're filing your tax return. So any of these investments and payments that you do, you can claim them when you're filing your tax return. If you could not submit a proof to your employer, or you made the investment after the date of proof of submission to your employer, you can still claim ATC. Now, even though I've added life insurance premium here, and I don't want the listeners to sort of see it as, a recommendation that you should go for life insurance premium. And remember that insurance products, they are kind of very, very complicated, and you need to truly understand, what is covered, what is the total sum assured, what are the various clauses under the policy. So don't Get insurance if you need it. Get life insurance if you have dependents. God forbid, if something were to happen to you, then they would suffer there economically. Then you must get life insurance, but don't jump into products that you don't truly understand. So life insurance policies are pretty complex, and the way they are structured, you need to truly understand them. So it's not really a recommendation that you should go for a life insurance policy. But if you do have an ongoing policy, then remember to make the premium payments. If you don't pay the premium, then you don't have the insurance. So if it's an ongoing policy for you, keep making those premium payments. Of course, you can cover the entire ATC with help from ELSS. And let's just move to the next slide quickly and try and understand why I'm recommending ELSS to you, why it is one of the best options to save taxes. Let's just come to that. Right. So, firstly, what is ELSS? So ELSS is a type of a mutual fund. I can just take a step back beyond, even explain to you what a mutual fund is. So what really happens is that, our most financial markets and regulators understand that not all of us have the time and the resources to invest directly into stocks. We are not able to truly understand how stocks move, and there's a whole lot of technical analysis and whole lot of detailing that goes into investing in the stock market. And if you're salaried and you have a full-time job, it may not leave you with enough time, and you may not have enough resources to invest into the stock markets. So what financial regulators do is that they allow the creation of a mutual fund. Now what this means is that a particular agency or a bank, or an AMC, what we call an asset management company, may put together a fund, right? So they have to take approvals from SEBI, they have to define their scheme, they have to explain what they are going to do, what kind of investing they are going to do, and there are like whole lot of regulations that they need to meet, several criteria that they should meet, and they have a fund manager. So this fund manager has all the time and all the resources to get into equity markets. So sort of they release a fund or a new fund offer, which is a new fund, or you can actually get into an ongoing mutual fund as well. So some schemes remain open forever, some schemes open and close, and you can look for a suitable ELSS scheme, and I'm going to come to how you can do that. But so this is how a mutual fund is really structured. Now ELSS means an equity linked savings scheme. What this means is that ELSS invests 65% or more of the total fund it collects from its subscribers into equities. Now, what the earlier, ELSS had even better tax benefits, as in whatever return you got from ELSS was completely exempt from tax. Now that has changed. Income from equity mutual funds is taxable beyond rupees 1 lakh. If you have a gain beyond 1 lakh, then it becomes taxable at the rate of 10%. But this is the only mutual fund investment that gives you a tax benefit at the time of investing. So I'm just going to repeat that. ELSS is the only mutual fund investment that gives you a tax benefit at the time of making the investment, because it is eligible under Section 80C. Now, ELSS truly stands out from everything else that is present in ATC, and we've gone over what all is there in ATC, and you can actually look it up on our website. You'll have PPF, EPF, principal repayments, children's tuition fees, and all of that. But out of all of these products, ELSS actually has the shortest lock-in period. So, what we hear down the street is that people don't want to get into these traditional products because you don't have the flexibility, you can't exit, and you can't take out the money when you need it. So ELSS allows you an exit after 3 years. However, we recommend that you continue to stay invested for at least a period of 5 to 7 years, because that's when your returns are phenomenal. They go above and beyond. So in that sense, if you look at from a regulation perspective, then this has the shortest lock-in period. PPF, like I said, minimum lock-in is 15 years. You can withdraw after 5 years for certain specified emergencies. You have to submit the proofs, and you have to go to your bank and you have to make a declaration as to why you want to do an early redemption and why you want to take out money. It has other restrictions. For example, if you become an NRI, then you can't open a new PPF account, although you can make deposits to an existing PPF account. So there are various regulations, and therefore if you compare this product with other products, then I think it has the shortest lock-in period, and it's pretty attractive in that sense. The other and the most important perhaps advantage of investing in ELSS is that it offers superior returns. Now, because ELSS is equity linked, and many of you will understand what equity investing can offer, these funds are able to give you superior returns. And I'm talking in the vicinity of, say, ranging from 11-12% to around 15%. And I'm not considering the pandemic period. I'm talking even prior to that, these funds were able to offer a phenomenal return as compared to others in their league. So in that sense, it makes them pretty attractive. And if you are somebody who's pretty, focused on investing, and you understand the mutual fund and you understand portfolios, then I feel that ELSS definitely has a place in your portfolio. Amongst all the debt fund investing and the index fund investing that you may be doing, if you do ELSS, you're able to meet the twin objectives of exhausting your ATC as well as investing in a good equity linked product. And all you have to do is just hold on to your fund for 5 years or so, and I'm sure you'll be looking at great returns. The other flexibility you have is to invest via SIPs. Now, SIPs, for those who don't know, is a systematic investment plan. And what this means is that you sort of give a declaration to your bank that on a monthly basis, and you can set up any frequency. You can do once a week, or you can do a smaller amount once a week. You can do bi-monthly, which means twice a month, or you can do monthly, or you can do quarterly. I mean, whichever manner suits you. Whenever you have the cash flow, then you can do a SIP. And I'll tell you how I do it. So I have a couple of SIPs going on, and I've put different dates. A lot of money goes out of my account the moment it hits. So that prevents unnecessary spends. So you can put a SIP, when you know your salary date. On the next day, you can set up a SIP for investing. And then, you can set up SIPs down the month, or, you can do a monthly SIP. So whatever plan works for you, you can get into SIP investing, and you'll not even feel, in the previous example, we saw how by doing 8,000 rupees a month, this person was able to contribute 96,000 rupees on an annual basis to ELSS. And if you do 2 SIPs a month, so that's like 4,000 rupees that you have to take out, say, twice a month. So I think that's a great way to get into ELSS, to do investing via SIPs, so that you don't take a hit. So say right now, if you haven't actually exhausted your ATC, just go to your income tax computation, which is offered by your employer. Ask for your tax computation and see how much balance is remaining under ATC. And you can actually choose to do 3 installments right now. So you can whatever is your balance remaining from ATC, just divide it by 3, make one today, tomorrow, and then make the next one in February, and make the third one in March, and you would have done your ATC for the entire financial year. So you don't have to take that huge hit right away. You can do in installments, you can do SIPs, and whatever SIPs are hit to your bank account in the next financial year will, in April, will obviously be eligible for tax deduction in the next financial year. But you still have time. You still have 2.5 months to finish your tax compliance, to finish your tax saving for this financial year. And I would highly recommend, the weekend is approaching, it's Thursday today, take out 5-10 minutes, look up your tax computation, see if you've exhausted ATC, and if you haven't, then whatever balance you have, you can just go ahead and do an ELSS. And in the next slide, I'm going to talk about how you can do that really quickly with Black, and how we've actually made the decision making pretty simple for you. That's coming up next. And then, of course, like I said, on Black, completely online process, completely hassle-free. You don't have to sign any document. There's no going to the bank. There is no submission of any personal documents identification that you need to do physically. So even though you may be occupied with office work, and you may be occupied with submitting tax proofs, if you haven't exhausted your ATC, just download Black, and I'm just going to walk you through how you can do it easily. Yeah, I think now that we are talking about Black, I'm going to come to this slide first and take you to the other one back again. Now let's understand what Black can do. And for those of you who don't know, Black is an app which has been brought to you by ClearTax. You can download it and just go through the app. You'll find that it's very, very convenient. If you've done tax filing on ClearTax, we've replicated the same experience. You'll have simple, easy to follow screens and ways and methods to understand how to go about saving. What we've also done is we've put together a list of top ELSS funds which are available on Black. Now, this is a list of top performing ELSS funds that have given the best returns in the last 3 and 5 years. So you'll have a nice snapshot of how, and I'm going to show you these snapshots, but you'll have a look at how which are these mutual funds which have been performing really well. If you're someone who's looking at a mix of top quality LSS funds, you can take a look through Tax Super Saver Pack. Then you'll also have some 5-star rated tax funds. So all the funds that have been rated 5-star by Morningstar, that's an entity that tracks numbers on the stock market. So it's a pretty reliable source. So if you've we have some insights available to you. You can look up these 5-star rated tax funds, and this ensures that all users are able to invest in top funds. So our objective is simply to not only help you save tax, but to offer to you the best of the funds in the market. You can go for a Super Saver Pack, or you can just pick up one of the top ELSS funds. And like I said, download the app and you'll be able to do it pretty easily. Now, if you're someone who's looking at, some quick calculations, we also have a tax center. It's pretty popular. People come here to check, how much HRA exemption they can claim, any kind of tax saving tips. And you can even speak with a tax expert who's going to help you file your tax return. Or if you give you advice around tax saving, all of that is also possible through Black. Now, these are the screens that I was talking about. I'm not sure if you're able to really see them, but I'm just trying to help you understand that just how simple this is really to do. You don't have to, you may actually have a few friends who are doing investing and you can check with them, but this is all the information at the click of your fingers. It's pretty easy to follow. It's easy to figure out how you can do all of this investing on Black. There are various screens here. You can see the Super Saver Pack. I hope you're able to spot this, or just simply go ahead and download the app. There is the first slab actually shows you the top performing funds, and then there is a Tax Super Saver Pack. Then the next Tax Super Saver Pack shows you the fund distribution, and you can see how 4,000 rupees has been split into these 4 funds, and this is also another excellent way to make the most of it. So, if you're not able to choose which ELSS you should go for, then I would highly recommend you opt for the Tax Super Saver. And then, of course, you are able to go to the tax center and look at various calculators and do all of that as well. Now, I'm going to take a step back. We've understood what is ATC. We've understood how you can maximize ATC, and we've understood how ELSS is the best possible option under ATC, and how you can conveniently invest through Black, not only for your tax saving, not only to claim ATC, but also any other kind of investing. So remember, we offer anything under the sun that you may be looking for in terms of mutual fund investing, so just give it a shot and give us feedback around it. Now, a lot of people also ask, what about other ways to save tax? I understand ATC, or I've exhausted ATC. What about everything else? Now, let's come to health insurance premium. If in the past 2 years, we've seen that, COVID has really, it's been a shocker for all of us. And a small visit to the hospital can set you back by a few lakhs. It's no longer a surprise. We've heard of the healthiest of us getting into hospitals and hospital admissions or family members suffering. So I mean, without doubt, I think this is a great way to ensure the health of your family and also to do some tax saving. Rupees 25,000 can be claimed as a deduction for self, spouse, and dependent children. And additional deduction is also available for insurance of parents, which is another 25,000. So you have 25,000 for yourself, your spouse, and your children. Which should be dependent children, and additional 25,000 for your parents if they are less than 60 years old. If they are more than 60 years old, then the deduction goes up to 50,000. So in aggregate, this is around 75,000. And trust me, that's a good enough amount to ensure the health of your family. If you don't actually already have health insurance, I would highly recommend that you look for a plan that works for you and go for this. Just to give you some highlight, that around 56% of people who filed their tax returns on ClearTax have claimed health insurance premium as a deduction under Section 80D. So what we are noticing is that increasing, year on year, the number of people who go for health insurance is rising, and that's a good thing. It actually shows that we are all concerned about the health and safety of our family, and this is a great way to save taxes as well. Another product that you'll hear me recommending very, very often is National Pension System, or NPS. Now, this product may seem actually slightly complicated, but it's an excellent product. It helps you invest, into your retirement savings. So this is towards your retirement. Unfortunately, you're not allowed to touch this corpus until you retire. Again, except if there are certain emergencies, then about 25% of partial withdrawal is possible. But largely speaking, you don't touch this corpus, and you do some diligent investing till the time you're 60. And after that, it starts paying you an annuity. Now, 60 seems like for some of you, it's not, it's not something which is close by. It may be many, many years away. And that's the reason that, that is the kind of time frame you have to get into a pension product. If you start investing today towards your pension, then, I mean, it's a great product to get into. It's linked to the markets. It's linked to equity. Unlike PPF, which is completely government backed, which is actually a debt based product, and we can get into debt based products. But just to help you understand, these are fixed income products, which means how much interest you can earn on your PPF is actually decided by the government. It's not decided. It's because they don't get into equity investing, so they cannot sort of offer you exceptional returns. They are, the amount of return they can offer is limited because of the kind of securities that PPF invests into. But NPS, you're allowed to get into the market. So based on your age, you can actually go for an auto choice where, according to your age, your entire corpus is invested, or you can actually, go and select yourself how you want to do this kind of investing. There are various ideas and options to explore under NPS. And I feel it is a great way to not only save taxes. So if you open an NPS account, so, some people ask this question that my employer doesn't do NPS, how do I get into it? So all you have to do is open an NPS account. You can do that if you have banking with any of the banks. Explore if they allow NPS investing, and you can do directly through your internet banking, get into NPS, open an account. If you make self contributions, then you can claim 50,000 under Section 80 CCD 1B. Remember, this is over and beyond the 1.5 lakhs you'll claim under ATC. So you do 1.5 lakhs of ATC, and you do another 50,000 under 80 CCD 1B, and you've knocked off 2 lakhs from your total taxable income. So if your total taxable income is 14 lakhs, you've brought it down to 12 lakhs, and that's a lot of tax saving to do. So I'd recommend you to explore NPS. If you're supporting a differently abled family member, then there are a bunch of deductions which are available. And yes, there are other fewer deductions available which you can explore. But largely speaking, if you're doing your ATC diligently, if you're paying your health insurance premiums, and on top of this, the icing on the cake is NPS. If you also do NPS, then of course you've done what it takes to save taxes in India. And yeah, keep coming back to us. We will discuss this more at length. I'm going to go back from where we were. Now, it's a common query. We are always, when you receive, say you signed up on a new job, or you've received an increment, or your employer has offered you a letter which actually lists down your CTC. Your first question is, how can I sort of, what are the smart hacks around reducing my taxable income in the first place? So ATC is after your taxable income, right? You have to figure out how much of your salary is taxable, and from that you reduce ATC. But what if you're able to reduce your taxable income itself? And that would make things even simpler. So these are some ways to actually reduce your taxable income. The first one, and the pretty common one, is claiming your HRA, which is house rent allowance. Now, this is available to taxpayers who live on rent. So if you're someone who's living on rent, you are paying rent to somebody, then you can claim HRA. Now, some people have this arrangement with parents or family, and they claim HRA. But remember, government has got very strict around this. So say you're living with your parents and you want to claim HRA, then make sure you're paying that rent to them. Not only you should be paying rent to them, your parents should be including that rental income in their own tax returns. If you do these two things, you'll still be able to save tax as a family, because your parents may be in a lower salary bracket, or they may be facing a lower rate of tax, if at all. Then you may be able to save tax in that fashion. So, but if you're living on rent with a landlord, then just make sure you take rent receipts, you take PAN number of the landlord, and you do what is required by your employer, and claim this tax benefit. So once you claim HRA, your total taxable income itself reduces. Then of course you can claim LTA. Unfortunately, many of us have not been able to travel. But if some of you have actually traveled within India, on a staycation, I think staycations are becoming fairly popular. If you've done that, then yeah, there could be a possibility for you to claim LTA. Remember, you cannot claim LTA at the time of filing your tax return. So if you've done any travel, make sure you deposit all the related proofs well in time to your employer, so that your employer can offer you this tax deduction, and you're able to claim it. The other way, of course, is to opt for reimbursements. If your employer offers telephone reimbursements, if you have broadband reimbursements, if you have fuel reimbursements, all of those reduce your taxable income. Like I said, if you're able to reduce your taxable income itself, then the effect of ATC, you also reduce 1.5 lakhs under ATC, and you'll end up paying even much lower tax. The other way is to go to your employer and request if they can start depositing to your NPS account. So even that's possible. Say for example, you are in a particular job where they have NPS, and you move jobs and your new employer does not have NPS, then go to your employer and make that request, that is it possible for them to deposit a portion of your CTC into your NPS account. Now that may actually reduce your take home salary, but ultimately you'll have more corpus accumulating in your NPS account, and that's definitely a good thing, trust me. Even if your employer, so usually your employer, the amount that your employer can contribute is restricted by the government. There's a certain percentage of your basic that is allowed to be contributed, so it's not really a large sum. You won't be hit by a significantly large number. It will be something that you can take care of, I'm pretty sure. So work with your employer and see if you can go for NPS. Now, a lot of organizations, and I'm seeing a lot of youngsters these days, decide not to contribute to your EPF, and I'm not sure why you would do that. as part of your larger portfolio, I think EPF definitely has a place. So it's employee provident fund, and again, contributing towards your retirement, and try and make contribute 12%. If your employer is doing only the minimum, which is rupees 1800 per month, try to do 12% of your basic. And if your employer is doing only the minimum, you can go for VPF. Now, a lot of people ask, what is VPF? They don't, it seems like something very fancy and different from EPF, but it's EPF only, just that you make voluntary contributions. So, to your same EPF account, you tell your employer, look, you may be contributing 10,000, but I want to do an additional 5,000. So, what you will see in your payslip is your 10,000 rupees of mandatory EPF contributions and another 5,000 that you want to do voluntarily. So, what this does is that it adds more and more money to your EPF account. You can definitely choose to do this. It's a right way to invest money even before it hits your account. And EPF contributions, as you know, are eligible under 80C. So, even your VPF, whatever you deposit voluntarily, is also eligible under 80C. So you can do this twin purpose, invest to your EPF account and also claim 80C. And if your employer is not doing enough, then it's the bare minimum which happens in your organization. Then you can voluntarily make a request to contribute even more. But remember, don't contribute a huge sum, because if you're contributing more than rupees 2.5 lakhs on an annual basis to your EPF, which means your contribution, not counting in your employers, because your employer also contributes to EPF. If you are contributing more than rupees 2.5 lakhs to your EPF account on an annual basis, then the interest on the excess contribution made above and beyond 2.5 lakhs, the interest earned on such excess shall be taxable, right? So keep that in mind. Make EPF contributions, make extra VPF contributions, but don't cross that 2.5 lakh threshold. And don't forget to ask us if you have any questions, and we'll help solve all your issues. Also, one quick gentle reminder, make sure you're depositing all your investment proofs to your employer, whatever may be the due date. If it has already passed, I'll tell you how you should not worry. But if it has not passed, then make sure you you submit these proofs, especially all the proofs related to reimbursements, LTA claims. Make sure you are depositing these proofs to your employer, so that your employer is able to pay to you these in a tax-free manner. You will not be able to claim any reimbursements at the time of filing your tax return. You will not be able to claim LTA exemption at the time of filing your tax return. So make sure you deposit your investing proofs with your employer on a timely basis. And if you do ELSS, if you invest or you take a life insurance premium, or you do an ELSS, you can still claim it when you're filing your tax return. However, the investment has to be made within the financial year for which it is being claimed, right? I think that's pretty straightforward. So you have to make investment before 31st March 2022 to ensure that you're able to claim it when you're filing your tax return. That you don't have to worry about. If you fail to submit to your employer, don't worry about it. Just include it in 80C when you're filing your tax return, and you will receive a refund. So, when you submit your tax return, you will see that you have a refund due from the government. And once you've finally submitted your ITR, it is processed, you verified it, then you will be refunded that excess tax. I hope that made things pretty clear for you. I think I've crossed the time limit somewhat, but I hope you found this session useful. Do let us know if you have any feedback. Thanks for taking our time on a Thursday evening, and we will see you soon again. Thank you so much for joining us. It was wonderful for me to come and share my ideas with you. And I look forward to catching up sometime real soon. Thank you. Bye-bye.